everyone joining in. We're going to begin in about 1 minute, but while you're on, I wanted to take this time to show you about a new feature that we've been working on the member site. So if you're here on the member site and you go up here to Factor Members, section that I've been working on right now is under the Knowledge Center, and it's this member Q&A. So we had this section before, but we've just readjusted. So the new member Q&A, if you go to it, it now is a scrolling feature, and all of the questions, you do not have to click to read more. So then it's nice because then you can kind of scroll through and scan, user friendly, not as much clicking. You don't need to do as much clicking to get to what you might be looking for. I'm also using this feature a lot for if there's common questions that we get. So check back weekly, daily, check back often. Another thing I wanted to tell you is, so this top section, I'm new here. I'm trying to arrange that it always stays at the top. So when you come back to the Q&A section, scroll through to see the new questions will be underneath here. So when you come and you see this at the top, don't think anything new hasn't been added, because it is probably then the question right underneath. And I would say this is a good place to start, even if you're not new here and you've been a member for a while. I've kind of pulled all sort of different documents that are throughout the entire website and put them here with lots of clickable links. So then you can go through here and it kind of just takes you to different places on the Factor website. So that's what I'm hoping, that this will be a place, a good resource for you to come to. So I hope this is helpful. Again, if you have any other comments for the service or things that you would like to see happen, feel free to send those to me and I will do my best to either make it happen or sort of put it away as a future maybe item. And with that, we're going to begin. Thank you so much for joining us. We are excited to have our December member Q&A. My name is Jolene Olson. If you did not know, feel free to contact me if you have any questions about the Factor service or your membership. Peter, welcome.
Yeah, thanks for joining me on early morning. Jolene, you can hear me. My sound check is good.
Sound good, and I can see you. Thank you.
Okay. I always appreciate you folks who are willing to donate maybe an hour of your time to do this every so often. I enjoy connecting with you in this way. I enjoy connecting with you when your emails get through. I value you all. So I just want to tell you that I appreciate that, you hop on and, you listen to what I have to say or ask questions, and we can connect this way. I have about 10 minutes of remarks starting in and some comments, and then I'll turn it over and we'll spend most of the time answering your questions. But as many of you know, when I say 10 minutes, it probably means longer, because I have the tendency to mope along. So anyway, just I want to bounce off of one thing. Last time we had a webinar, my computer crashed. Some of you may remember that, and that was the end of the webinar. And Jolene and I then attempted to recreate it and tape it and make it available. But I want to talk about computer crashing. I trade off about 3 different platforms. And there's a danger if you've got orders in your working orders, you're trading off of alerts that demand a computer connect with you and so forth, that you crash and all of a sudden, it's like putting a bag over your head when you're flying or driving. You're flying blind. So, just make sure that you have backups. Have triple backups. I know numbers that I can call. I have numbers that I need to call if I go blind. I have my platforms on iPhones, iPads, multiple, 2 computers, and I have people I can connect with in case that happens. So always make sure that you have redundancy in your order stream and in your quotes, so that you don't find yourself experiencing a huge overnight loss because you happen to not know where markets were and were scrambling and so forth. So just that's that comment. Just want to make a couple comments on the markets we have. We have big volatile swings going on in markets like U.S. equities, British pounds, some of the currencies and so forth. But we're within a trading range, and so these are not the kind of markets, as I pointed out, really going back to a September factor, where I made the comment that we're entering markets that just are not my kind of markets. And we could have the discussion of when markets aren't your kind of markets, why don't you trade? I mean, why don't you just trade the way you're trading? Go to a different approach. And that's a whole different conversation I'm not going to engage in at this point in time. But it's been my decision for decades now that I'm not going to do that. I'm going to judge whether markets are consistent with the way I trade. I don't believe it's effective to always be changing your stance at the plate. Again, to use a baseball analogy, it's using sports analogies or your stroke in swimming or whatever, just because you've lost a little time in your laps. And so my preference is to crunch down, try to be a little more selective on patterns, size down, greatly size down, in fact, and to weather the storm. And at some point, markets become more favorable. And I mean, my only position at the current time in my trading account is long URA. That says a whole lot about my thinking about the markets, that I'm long a dinky little stock like URA, and that's it, with no futures or forex exposure. That should tell you what I think about current markets, and I'm not in any rush to get back into markets, but at the same time, I realize there's a danger in being on the sidelines for so long that you tend then to have the tendency that I only now want to take a trade if it's an easy trade to put on. And I've had that conversation too, is the best trades are the hardest to put on. And they're even harder to put on if you've been sitting on your hands for a while. So I'm cognizant of that as a discretionary trader. I want to talk about a comment I made in the last update or so, where I said that consecutive losers that I had was a 2 standard deviation event. There's been quite a bit of email and comments that have come to me about that, explain exactly what that looks like to have a 2 standard deviation event in drawdowns. And one person even came and said it's not a 2 standard deviation drawdown because you've been wrong 10 in a row. And if you have a 50% win rate, 10 straight losses it was an astronomical probability of 10 straight heads and flipping a coin. I mean, if I have a 50% win rate, that's equivalent to flipping a coin and having tails come up 10 straight times. Probability of that is really astronomical. It's kind of once in a career lifetime, which in fact is quite rare. But so this is your standard deviation basic bell curve graph, and what it shows is 2 standard deviations is about 3 is 0.1, but it's about from 2 on, it's about a 2 point. Well, it should be over on this side. It's about a 2.3 percent event, which means that any series of 10 straight trades, only 2% of any sequence, of any DNA strand sequence of trades that go on for years and years will experience a 10 consecutive losers if it's at 2 standard deviations. You cannot really use the heads, tails, 10 heads in a row comparison. It's not an accurate comparison because when you're dealing with 10 in statistical probability, it violates the law of large numbers and you get a subsequence. Keep in mind that it's really not, during any short period of time, a 50-50 chance, because in reality, if I look back over the last few years, my average winner has been 65, 75 basis points. My average loser has been 20 to 25 basis points. And so there, all of a sudden, we have a 3-to-1, a 3-to-1 sequence, not a 50-50 sequence. And so that's what it ends up being, even though as a drawdown itself, because of my risk management, it really has not, it's not been real painful. It's not been fun. I mean, I hate losing streaks. So, it's never fun to have one. But the reality is I have them, and you go on with it, and it doesn't. there's at no point in my career at this point where that kind of consecutive loss streak or difficulties in the market is going to dissuade me that what I'm doing needs to be changed, and I need to greatly alter my approach to the markets. I have good confidence in what I do, and sometimes you have a win streak, you have a loss streak, then you have to kind of regain it. When you use tight risk management, you regain it in one trade. So I never really want to be more than one or two good trades away from my sequential all-time net asset value high. And I want to talk about that in a minute. I've talked about really four ways that I believe are the most honest ways of maintaining your performance data, and rate of return is not one. I don't like rate of return. It's not a good metric. It's not a metric that reflects reality. You can have a huge rate of return, but if you have tremendous asset volatility, what good is that? And so, in fact, I'm in the process of updating the paper that I did some time ago. I'm not exactly sure on trading metrics, on metrics that matter. One being gain to pain ratio. If you are not keeping track of your gain to pain ratio, entering the outcome of each trade on an Excel document or a similar type statistical recording document, I think you're missing the boat. You need to maintain gain to pain ratio and or profit factor. I mean, either one will work. I keep both. They tend to be similar. Although profit factor will always be, maybe 100 basis points higher than gain to pain ratio, but you need to keep it. And what you do there is you put on you take off a trade, and that trade equals 1% of your capital. So it's a 1% trade, and you add it into the cumulative number. And next trade, you lose 30 basis points, you subtract it, and you do it on a sequential close trade basis. That is a line that I really pay attention to, because that is a line that I don't want to go down. I mean, it will go down, it will drift sideways, but my goal is to keep that line from within 1 to 2 good trades from a net new all-time career NAV value. And that's a line that I'm very concerned about. I just want to show you a graph. This is the sequential closed trade rate of return for the factor tracking account for 2018. Again, my focus is I don't want this line to have a big dip. And that's why I use aggressive and active risk management. Is I want to cut trades that are starting to go against me. I want to, to the best of my ability, ride trades a little bit that are going toward me, because the whole focus of that is to keep the sequential closed trade cumulative net asset value of an account from having a big dip, because big dips have to be recovered. Recovering from big dips is something I have done way too many times in my career. And it is something that I have attempted to swear off of, although it won't happen. And what you see here, of course, is, the recent series of trades where we're starting to roll over. And, my goal is to keep it from having a severe rollover. If I have a 3% sequential close trade rate of return, in terms of mark to the market daily drawdowns, that's probably, as a general rule, going to be 2 times that. So, 6% mark to the market day to day drawdown is a good estimate of where I am. If I go to an 8% drawdown based on statistical probability of my actual performance, all of a sudden goes into a 2 standard deviation range. This is the factor tracking account since the inception of the factor in January 2014. Many of you have been with me since that time, and you have no idea how Jolene and I really covet your support and your encouragement that we hear from you along the way. Again, my goal is to keep this line from having a severe decline. If my focus is on the next trade that's going to be closed, where is it? It's not on the charts. I mean, the charts are my mechanism for triggering trades. But to some degree, this means that I trade my equity in some proportion to how I trade my charts. But a chart pattern to me is meaningless, or a chart outlook to me is meaningless if all of a sudden I have a trade that's gone into the red. Okay, I'm going to touch on one more thing. Sometimes I'm asked, Peter, you're active, you're in and out. My style is much more relaxed. I want to take a trade on small, sized extremely small, and I want to hold positions for longer. And I think that's a very legitimate way to trade. In that way, it's almost trading off of weekly charts and monthly charts, paying no attention to daily charts. If one is a classical chartist, now, if one's not a classical chartist, then that's open for a whole nother dialogue. But if I were to move in that direction, say I don't want to trade 100 times a year, which is about where I trade right now, but with tranches, it's more closed trades than that. But my goal has been 80 to 100 times a year. In fact, tracking account, again, it's higher than that once you look at re-entries of trades and tranches and so forth. But if I were to try to say, okay, I'm only going to trade 20 times a year, and I'm going to size way down, I'm going to try to build a position, I'm going to try to hold positions for months instead of days or weeks, then I look for bigger patterns, and there are some things taking place. I'd look at a market like corn, and I think corn is going to have an enormous move in the next 2 years or so. This is a chart of the world ending stocks of corn, and this goes back to 1961, and this black line here is 50 days of supply at the end of a crop year. And you can see that this year we're expected to drop below that level, and we've only been below that level 3 times since the early 1960s. We've approached it a few times, but only 3 times, and that's extremely tight supply. That is what in cash grain circles you would define as the supply that you need to keep the pipelines filled, the export channels, the barges on the river, the minimum supply at grain elevators, minimum supply by those who use corn, corn flakes, whatever the case may be, corn syrup. It's a minimum supply. It's pipeline supply. So it means things are very tight. You have any surprise in the market, and you're gonna really see it in price. Okay, Jolene, I want to change screens here. Let's see here. How do I do that? Here we go. Okay, I just want to show you a quick chart. Jolene, and do you see the corn? Is the corn chart up?
Yes, Peter, we see that. Thank you.
Okay, this is a monthly corn chart, goes back to 1968, and these red lines equal the peak of these periods that we saw over on the ending supply chart. The 3 other times in which we dipped below this level or approached this level for more than 2 years. And you can see the corresponding price action that took place. And, I've talked about grains being down in a level of deep historical support. Now, people have asked me, well, why couldn't this whole area here be defined as a head and shoulders top, especially on beans, you see it. And, that's not what I buy. I just don't think you can think that way about charts, because that projects a minus $6 price for corn, or at least you approach zero, and I just don't see that as realistic. So I think we're in a big base area here. You look at the weekly chart, we're putting in a possible symmetrical triangle on the monthly chart. If you kind of violate some, you violate some of the spindles that took place. A daily chart, we're forming a symmetrical triangle. This is continuation chart. This is the chart of the July contract, where you have a head and shoulders bottom potential. This is the kind of thing, if I'm going to trade 20 times a year, I'm going to undersize my trades. So instead of trading a contract for 10 contracts per million of equity, I start and say, okay, I'm going to trade 3, and I'm going to try to build a position, and I'm going to try to catch a right shoulder low, or the final low of a rectangle, or something like that. That's a legitimate way to trade. And if I traded that way, if I happen to be trading that way right now, this is, I'd be looking to build a position here. Now, in the process of building position, I'm not going to let myself, I probably wouldn't use stops. And so you've got to withstand, you have to have the capital to withstand adversity on a short-term basis. What you have here is a whole different way of trading that will result in larger drawdowns than an active and aggressive risk management approach. But I just wanted to point that out. Okay, Jolene, I am ready. Documenting your trades. I'd be interested in understanding how much information you gather on one of the trades you put on. What kind of journal do you hold? Excel, paper, other method? Do you archive your charts? Do you have a small comment as to why you put a trade on? I used to, not as much anymore. I mean, I don't. It's in my head. I don't keep the kind of journal that I used to keep because I found that my metrics are really what I want to be keeping. I meant that there's two levels of accountability that I hold myself to on any given trade. One is just an attempt to be self-honest at the end of a trade, looking at a trade, saying how would I have done it different. But I'm not entering physical journaling on that point of view. What I'm really doing is making a subjective judgment on a trade itself. And of course, I kind of grade myself at the end of the year. Some of you know, as I had a C+ year or B- year in terms of, not in terms of performance, but in terms of my ability to follow my game plan. Because as a discretionary trader, I sometimes get caught up in the moment and blow it. And so I don't keep a physical or online journal trade by trade as such, but I am very aware of each trade. I'm very aware of whether I followed my money management rules. I like to define myself as maybe 50% systematic at trade entry. I know what patterns I want to do. Once I put a trade on, I move to probably more 90% systematic following trade management rules. So I'm well aware how I'm doing on that. Second level of accountability is, I kind of have an unofficial board of advisors for Factor, and there are guys that don't trade like me, understand the way I trade, but are extremely successful market speculators. I meet with them. I meet with them physically each year. That's why I go to Scotland each year. And just to sit down and talk markets, to talk about trades that were good for me and why, trades that were bad for me, then why. Market outlooks, themes, Peter, okay, that was a pattern you identified. Now, how'd you do? How'd you do on it? What was your execution? So, I'm well aware of that. And of course, I think that probably the third level is each year when I do the best dressed list of the 10 to 20 patterns with the best dressed, I want to make sure that I probably traded halfway decent on at least a third of them. If I did that, that's probably a B- grade. If I happen to catch 10 of them and traded my rules correctly, and then I'll grade myself as an A-. And so I have that kind of level accountability, but really it's metrics. It's metrics that I'm paying attention to. And I think that if I found myself in a situation that my metrics were falling below where they needed to be, then I would probably step back and take a much greater look at why those metrics are becoming sub levels to where I am. And I would say sub levels for me is I don't want my profit factor really to drop below 2 in any given year, or really any given rolling group of 25 to 50 trades. So that's the accountability that I hold myself to. I do not keep a physical journal anymore. I did at one point in time. I used to have a little write-up on every given trade. I no longer do that. Now, if you are fairly new, you're trying to find your swing, you're trying to find your sweet spot to swing at, I would highly encourage you that you would do that, because I think in the process of doing that, you can find your trade. If finding your trade, I hope you understand what that means, but I think you can find your trade if you do that. Okay, Jolene, next. When you move a stop, break even, is this entry price or entry price minus the partial profit taken? And break even, considering the partial profit also is the 100 basis point potential profit taken. 100 basis point return on account based on the partial 100 basis point on entire position. Okay, I think I know what you mean. So let me talk around it, and hopefully I talk at it. Yeah, when I move to break even, it is break even on the tranche that I'm holding. It's not break even on the total trade. I don't say, well, I took a 100-point profit, basis point profit on the first tranche. Now risk to break even on the entire trade. It's on the tranche itself. I trade the tranche. And so now if I have a multiple contract position, which is always the case for me, not the case for factor tracking account, unfortunately, I've thought about moving the factor tracking account to a $200,000 block of money so that I could multiple contract it in futures. Yeah, generally speaking, I'm looked at taking half off at 100 basis points, or at least moving to something like the 3-day trailing stop rule, even though we're not 70% to the distance of the trade or back to break even on the trade, or close below the high day low, or something along those lines. To jam a stop, we've hit 100 basis points on a tranche or half of a trade. I may take it at 100 basis point profit. I may say, well, the nature of the chart itself is I think that we have more, but I'm not going to let it popcorn me once 100 basis points have been recognized on at least half my trade. I'm not going to let that popcorn. Okay, Jolene, possible. I don't like it. I mean, I've talked about this way too many times, frankly. But I think what we're talking about here is does the gold chart, in this case, it's an arithmetic chart. I could change it to a log chart quite quickly. But is this whole thing here a head and shoulders? And I just have a hard time believing that. The reality is that really big head and shoulders tend to have symmetrical balance. This shows that the left shoulder was 30 months. The right shoulder would have been 30 months as of June. We've gone past that. We've come down, and this 1124 is the right shoulder low. We violate that, and we're in trouble. And let me just throw this up real quickly. I'll throw up volume open interest. You can take a look at it, but you can see in a head and shoulders, a legitimate head and shoulders, your biggest volume needs to be at the left shoulder or at the head. And here we have massive volume on the right shoulder. And that is just not typical of a legitimate head and shoulders. And so I see that as a problem. Now, I will admit that this commitment of traders in gold is quite constructive for the gold market. And we saw how T-notes responded eventually to having very constructive commitment of traders, although commitment of traders is not as real-time valuable as it used to be. Nevertheless, it tends eventually to catch up with itself. And so I've kind of looked at this and said, well, we're flagging. We've got this a bear channel, an up channel, which could be a bear channel, but I could be wrong. And so for me, yeah, I mean, it could be, and it could be that what we're going to have happen here is that this right shoulder is going to just be prolonged, and is in effect going to be an ascending triangle. First point, second point, third point, fourth point. Now we can go up on with an ascending triangle, a symmetrical triangle, an ascending triangle in the right shoulder position. That could happen, but it's yet to be proven. So, I prefer to take a look, and right now I'm expressing an awful lot of raw material beliefs in equity markets and ETFs, and it's partially that's because it's a lower risk way to go when I'm uncertain about what the market is. And so here I'm looking at Barrick Gold, and I think Barrick Gold has this big falling wedge. I don't like wedges; it's a diagonal pattern, but you have this big falling wedge, and so I'm likely to take a position in Barrick Gold instead of the gold market as a proxy. So, okay, why doesn't factor include the nominal value of interest rate futures contracts in capital? I don't, because I think it's the question is I talk about what's my leverage. I'm at an X level. I'm at 0.3x, I'm at 1x, I'm at 2x. There are times when I'll get on out to 4 or 5x, although it hasn't happened, in a number of months. But I don't include the nominal value of interest rates because I don't think it's a realistic level. I'm really trading the coupon. I'm not trading the full underlying value, so I choose not to. I'm aware of the fact that I have interest rate contracts on, but the euro dollar contract's $1 million. It's the coupon on $1 million. And so, I put a euro dollar contract on, and all of a sudden, in fact, a tracking account, and usually, in fact, a tracking account, I try to do 2 contracts of euro dollars. That's the interest rate, not the currency. All of a sudden, I'm at a $2 million of underlying interest rate, and I'm at 20x leverage. Well, we all know that the euro dollar market's actually a rather calm market to trade. And so I don't think that the relative volatility of the market in terms of profit or loss is commensurate with a $2 million underlying value or a 10x position with 2 euro dollar contracts. And it's not quite as extreme when we look at bonds or notes, but again, bond market's $100,000. So I put a bond contract on. I'm immediately at 1x. And again, I don't, in case of a bond note contract, it would be viewed by the exchange as a $2 million or 2x trade, even though on a bond note spread, it's not worthy of looking at it and saying I'm 2x leveraged. Okay. CME agricultural markets, please don't say CME. I'm a board of trade guy. I can't think in terms of corn being a CME market. I mean, it just almost violates my, I feel like I've almost been mentally raped when people refer to agriculture markets as CME markets, the board of trade markets that happen to be overtaken by CME. Do you recommend to have entry and stop orders active during pit? Yeah, pit. I want to trade the pit. Now, I don't want overnight orders. I mean, I just like if I'm trading oats, there's no way I'm even going to have an exit stop, overnight. I mean, it's just not going to happen. But generally speaking, my attitude on that is I don't want overnight, especially overnight entry orders sitting in most U.S. markets. Now, exceptions would be gold, dollar yen, which really isn't an overnight market because we're trading yen in its prime periods. But dollar British pound would be an example. I don't want overnight orders in that, even though it's extremely liquid, one of the most liquid crosses there is. So I could conceivably do that. But so I'm awake at usually at 4:30. I take my first peek at the market with a cup of coffee in my hand somewhere before 5 o'clock. That's Mountain Time. I mean, it used to be. When I traded Central Time, of course, it was an hour earlier, but that's what time I get up and I get a cup of coffee. I take a peek at markets and see what might have taken place overnight. And then I start thinking about entering some orders. And so it's conceivable that I might enter a grain order prior to the pit open, but generally I will put an order in and specify that it be day order. So even though it goes onto the platform, it doesn't work until the pit opens. And there's still an active pit trade, by the way, at the Chicago Board of Trade. It's in the Chicago Board of Trade building, not at the CME building, but there's an active pit trade in options. There's an active pit trade in give-ups, which are kind of exchange for physicals that take place between a large commercial. So there might be a 2 million bushel order that takes place, and it doesn't go into open auction. It's recorded, but it takes place ex-pit. It's called an ex-pit transaction. It's the way that we used to trade when I was down there for Continental Grain, and we were trading with Cargill, whoever the case might be, ADM, something like that. We would do ex-pit trades. Yeah. Is it possible to identify false breakup before it occurs? I wish. Good luck on that one. There are some things you can look at. You can look at if it's a violent thing that takes place because of some spark news that takes place, like over the weekend with the China trade deal. It's something I didn't trust. And that's why when I saw beans 30 higher on Sunday night, I said, not only am I not working stop orders overnight, I'm not even working stop orders. At that point, I had day orders entered. I had day orders that were going in on the grains or alerts that were set, and I basically shut down that plan because this was all of a sudden a market that I really don't like, and so that's the way it is. Okay, my questions are Bitcoin related. Will there be a possibility, be a dead cat bounce? What will be the estimated range before it drops to 3K? Do you expect Bitcoin to touch 5762 massive resistance before it bottoms? Okay, in the first place, this is really a question that is kind of inconsistent with how I look at markets, which is Bayesian. So I can't really give probabilities on any of this. I kind of react to markets rather than anticipate markets. So, good question. This is Bitcoin. Bitcoin I like to look at on a log basis. Yeah, I mean, this is where we are. I believe that we've completed, a bear flag. I don't see us on the second part. I don't see us rallying to 5,700. I do not see a retest of this big descending triangle before it bottoms. And so, best case, my thinking had been 5,000. I'm short Bitcoin futures, not for tracking, unfortunately, because it was a lousy contract. But I covered half way too early, 4,600 range. I'd probably look to put out that half again should we rally back to 5,000. So I don't see 5,762 or 6,200. What kind of dead cat rally might we expect? We might have seen it already. We may, that could have been it. I mean, this rally here, 44.15 might have been it, but I'm kind of thinking we got one more bounce to bring in and give hope to the bulls, and that could be 49. Whether we put in eventually a bottom below 3,000, I don't know. We'll talk about it. I also talk about low risk entry. Can you go over a couple of examples? I'd like to better understand what he takes into account to pull a trigger on chart has met his pattern criteria. Let me think of a chart. I'm basically looking for, I hate to use the word quality because it's so ambiguous, but I'm looking for the quality of a breakout. I want to see a quality, a certain quality to a breakout, in order to pull the trigger. So, okay, I've got one. It's an anticipatory trade, so I don't really like that. Okay, okay, I know where I'm going. All right, let's take the Berkshire Bees. It's a market I really like. I'm going to trade it. I've not only traded it in my IRA stuff, which is not what I report about in Factor, but in my tracking account and in my prop account, I'm looking to trade. I trade this market again only because the indexes are way too wild for me, and so I'd rather express it in terms of individual equities. But at least prior to yesterday, I thought we were building a continuation head and shoulders. You look at the weekly chart, I think we're doing basically the same thing with an up-slanted neckline. You cannot call this a cup and handle because the decline was too steep. There are criteria on what represents a cup and handle or not, so you can't call it that. And so I thought that we're putting in kind of a slingshot to much higher prices, with 252 being a minimum. But even that, if you take this based on a semi-log chart, you go higher than that but I don't tend to look at things on semi-log chart. But on a semi-log chart, you going up and you're talking 259, 260. So for me, I look at this and I'm monitoring it, and I'm looking for the quality of the breakout through this 224. If we gap through crazy news, that's not a quality breakout. If we start testing this, I like the fact that we rallied and faltered. I like that because there's one more contact point. The more contact point at the boundary, the clearer the boundary, the more I think we have a quality breakout where we go. I've talked about before the fact that, maybe 70% of all the money I've net made in the futures markets and Forex markets throughout my career were in trades that broke out and never looked back. And so I'm always cognizant of that. I don't want to horse around with trades that are messing with my head and messing with my billfold, because the fact that they are doing so represents that they have now fallen out of the range of what I would call my net bottom liners. And that's those trades, the character of trades that put in 70% of year after year, pretty much 70% of my net profitability. They are trades that, even though I might use a 70, 80 point risk, they don't generally give me any loss. I mean, they wink at me maybe during the day and close well and go the next day. So, on this, my focus is always on smaller patterns. I like smaller patterns. I don't like what I call loosey-goosey long patterns. In this case, we have a weekly chart pattern, but that's what I would define as a loosey-goosey pattern. That I like this pattern. I'm focused on this pattern. So, I'm looking for a market that might creep back up and all of a sudden go through 224. The way I manage that trade in an IRA account is different than the way I manage that trade in a trading account. But, I'm likely to only have a 218.97, something like that, stop on the trade. And so I'll size it accordingly. Let's say I'm in at 226 and change, 226.02. I'm in at 226. I'm risking under 220, so I have $6. So that means I'm trading 100 shares per $100,000 unit of money at a 50 basis point risk. And so that's how I'm thinking in terms of trade. I'm always looking at that in terms of trade. Again, those that read my diary book are still somewhat stuck on this last day rule, which is what I employed at the time I wrote the book. And that's evolved since then. It's been one of the biggest evolutions of my trading, but I don't necessarily get hung up on last day rule. Hikaki, I wish I would have never mentioned Hikaki. Because people, like I mentioned, compound fulcrum, and all of a sudden I can't open up Twitter without seeing somebody talking about compound fulcrum. I'm going, really? I should have never mentioned it. It's a pattern developed by my friend Dan Chesler, or codified by him anyway. Dan's a longtime Factor member. But if, let's say, I'm looking for the long side of Berkshire B's, and, I used to own Berkshire A's. Of course, they weren't called Berkshire A's back then. Long time ago when it was affordable. I can't afford it anymore at $315,000 a share. But by the way, it has a similar pattern. So, if I'm looking at this, all of a sudden we drift sideways here for another week or two, and we put in a bullish Hikaki, I'm likely to act on that. Maybe not for tracking account, but I'm definitely likely to comment on it. And so if it takes place within the context of a pattern or the possibility of a brief pause in a strong trend, I'm likely to mention it. But I don't place the Hikaki in the same level of credibility that I would place, let's say, 12-week ascending triangle, or in this case, a continuation head and shoulders that dates back to the September 20th high. And so, you've got October, November, we're at 9-10 weeks of this. So, this to me is a much more significant thing. So Hikaki, I always look at in relationship to other things that are taking place in the chart. I would never use Hikaki. Now, there is a Factor member who is very data driven. He lives in Germany. I've spent the day with him, and great guy, great mathematician. He's really done a lot of statistical work. I need to try to find it because I have it around somewhere, where he actually programmed computer for Hikaki and took a look at it as an individual pattern, and he back tested against against quite a bit of data going back, and he found that it did provide a net profitability, a slight edge if taken independently. He then did a research report on it. I have a copy of it somewhere where he looked and said, yeah, if you did nothing but trade the Akaki and use some mechanical rules for doing so, you could carve out a slight edge. So, but I always want to look at in relationship to other things. Okay. I subscribe to Axel's, very good. Axel's a good friend. Can you tell why you were not very interested in trading equities? Furthermore, what's the main difference and precautions one needs to take in trading global equities alongside global futures market? I never traded equities because I love leverage markets. I mean, I can't go to 2x, 3x, 4x in the equity markets. I don't trade equities on a margin basis anyway. So if I traded equities, I'd be a cash equity trader. I fully fund every position I have. And so you're at maximum of 1x in the equity markets. And I just don't believe that long term, over the term of my career, I could have ever achieved a rate of return trading pure equities that I've been lucky enough, fortunate enough, in some sort of divine sovereignty to have accomplished what I've accomplished, not due to my own luck, not due to my own brains, not due to my own skill, but I think due to a lot of factors outside myself. But that's another question. That's another story. Anyway, so yeah, I mean, it's just I just think it's better off. I'm better off. And so you just have to realize that the net profitability of trading equities is not the same. Okay, you've described trading as throwing mud at a wall to see which sticks. From that analog, can one say that the more mud you throw, the more successful one can find? In other words, if we don't loosen the standards, diligence in finding, monitoring more markets leads, maybe. Yeah, I mean, instead of throwing 100 globs of mud at the wall, I throw standard globs of mud at the wall. But see, I would argue that the fact that I would throw 300 globs of mud at the wall in the same universe of markets actually does not meet the same standards and diligence in finding and monitoring. Yeah, I mean, you're saying monitoring more markets, but yeah, for me, that's really not possible because I only trade major to major currency crosses, major to minor currency crosses. I don't trade minor to minors, so that's gone. I don't trade illiquid futures markets, and so I pretty much monitor all the futures markets that are viable. And so it's not really possible for me to have n equals the number of markets I monitor. It's not possible for me to greatly expand n equals. So, okay, Jolene. New York C markets from Hal, coffee, cocoa, cotton, copper. Yeah, I've always felt like back in the pit days, it goes back to the pit days where I just always felt like my orders were played with, my orders were messed with. Copper, not so much as cotton, cocoa, coffee. But you'd put an order in, you'd put a market order in, you couldn't get a fill, you have to do an order check, you get a stop hit, you can't get a fill, you wait till the end of the day. I always had the feeling that these local traders were waiting till the end of the day to divvy up orders, saying, well, Joe, your son's entering Harvard next week, you need money for tuition. So I just felt like they weren't honest dealers, and that's how I always felt. And I think even now that we've gone electronic, their patterns I don't trust, their markets I don't trust. I still think they're kind of messed with, not so much by speculators, HFT, algos, but they're messed with by the commercials. The commercials mess with the markets. They mess with the data flow. Because so anyway, does a 50 basis point risk refer to 0.5% risk of a particular position or the trading? Neither. It's not, okay, I buy a Berkshire Bees at 226, so I'm risking 10% is 22. Yeah, it's not like, okay, I'm risking 0.5% of the underlying value. I never define risk relative to the underlying value. I never define risk relative to the margin used. I've never defined risk in those ways. I've never defined risk relative to the trading portfolio. If portfolio means the total number of positions I have on, I always measure risk relative to total nominal capital, the amount of money that I consider myself to be represent my account. Okay, I read your blog post where you brought up on Twitter yesterday and was more wondering if you could provide more details on stop loss setting and adjustment techniques you employ to increase your gain to pain ratio. I read a post about 3-day trailing stop rule, wondering if you could fill in some details. Apologies, I haven't read diary. Okay, I will try next time I mention 3-day trailing stop rules to not only just enlarge the chart and put a box around it, but actually describe what takes place. Jolene, maybe you could even, I think it's only 2 pages. I mean, it's throughout diary, but I think it's a 1 to 2 page description. I think it's more than 1 page because it spills over to the next page. But I think there are opposing pages, so you could take a copy of it, convert it to a PDF, and stick it online. Yeah, anyway, let me go back because I'm in the short. Yeah, I'm not gain to pain. Again, that's not necessarily adjustment techniques. That is the fact that I use, well, it is, I guess. It's active and aggressive risk management. I don't want the line to go down. By not letting the line go down, I increase my gain to pain. Okay, how does Peter enter orders? I know he used to wait until the market closed, but change it in recent years. Does he have entry stops in the market, or does he have alerts and decides when he gets alert? Yeah, I still do wait because I still consider the closing price to be extremely important. I mean, if someone were to say to me, Peter, you can only have one variety of charts, that's it, no other variety, that's it, one variety. I would choose a closing price chart, a line chart. A closing price chart would be, to me, the most valuable chart to use. And so to that degree, yes. And to that degree, most of my orders, if they're day orders or changed orders, take place after the close. And so to some level, yeah, that's still, entry stops. I'll put entry stops in markets, especially during the day. Some markets I'll use alerts. I used an alert, for instance, on the retested head and shoulders and bonds. I had an alert on cash bonds that went off yesterday. But again, I wasn't going to sell bond futures just because the alert on the yield went off. I want to see something more than just an alert. But I have alerts all over the place. I've got alerts always. My phone's going off usually once a day on an alert for a market I'm looking at or price that I'm interested in seeing what happens. So yeah, I use a combination of alerts, good to cancel orders, overnight orders, day orders, mostly day orders. Okay, Jolene, I'll answer. Let's go to one more. I might have time for 2 more. How do you handle patterns that are obvious where everyone else is watching and potentially crowded? Would you trade like a yield breakout, be lower odds due to this? Somewhat, but let me tell you, most market, you and I look at charts, most people don't. If you look at total open interest of a market and say, okay, what percentage of that open interest is represents a position that is chart based, you don't have a big number. Here you show open interest in Dow futures, for instance, at 73,000 contracts. S&P is going to be bigger than that, but S&P is okay. So we're just coming into expiration. So you've got open interest. Let me put that 3 million contracts, 3 million 49,688. Just over 3 million contracts. What percent of those contracts were put on based on the chart structure? Very small amount. And so even though you and I may feel like we both see the same chart, and other people do, we represent a very small proportion of potential buying and selling that takes place in the market. Even technically, once calculated, and I think it may be higher than that, is that 95% of technical position size and volume represents an approach other than classical charting or chart points. They tend to be no more numeric, especially HFTs tend to be, they get to buy the bid, sell the offer. That's another story. Okay, let me try to do 2 more, Jolene. if you had not had pit trading experience back then, how would you trade those markets today? Many of us came into trading after pits closed and those markets turned to electronic. I think I had a big advantage. I mean, not just in terms of pits, that I understood order flow, that I got to see order flow up close. In what that order flow looked at, and what looked at intentional order flow, what looked at commercial order flow look like, what panic order flow look like, so forth. Still takes place, but doesn't take place in a pit. But not only that, as being in the board of trade, I had a community that's impossible to replicate today. You know, I went up and down in the elevator with good traders. When I'm trading off floor, I'm trading in an office with good traders. I'm on the floor with good traders. I have dinner with good traders. I have social relationships with good traders. That's something that can't be done today. So I don't know if it would have affected necessarily exactly how I trade the markets today, but I think that it does impact my understanding of market speculation, and that has at least an indirect effect on how I trade. Okay, Jolene, I'm going to do one more, and then I've got to run. Sorry, guys, I got something to do with my son and daughter-in-law this morning. What qualifies a chart? What quantities of a chart do you find have real predictive value? Well, none really. And again, I don't consider charts to be predictive in kind of the sense of being predictive. I mean, you don't predict prices, you don't predict trends, you react to. There are certain charts that I find are better to react to. In the minute you talk about predictive, what you do is you take the conversation outside the realm of real risk, real reward. You remove it from tactical considerations, which is fine to do as an analyst, or it's fine to do as an opinion expresser. It's not necessarily reality for somebody who tactically must execute things that they might see that might have some predictive ability. And so, you know, I've just found over time that, diagonal patterns are far less reliable than horizontal patterns. That means you have a pattern that's clearly identified where the breakout takes place through a line that is either in the direction, a boundary that's either in direction of the trend or flat, horizontal, and not diagonal, such as the wedge symmetrical triangle, the upside breakout of a descending triangle, that sort of thing. And so I've just found that breakouts of horizontal patterns tend to be more reliable. I have found that 13 to 26 week or 10 to 26 week patterns are more reliable. That patterns which are what I call oasis patterns, you don't have a lot of price action to the left of the pattern that you're looking at. The constructed pattern you're considering is not just the tail end of a whole bunch of messy price action like you'd have in the stock indexes, let's say today. And so you had a big trend into a pattern, and then you form the pattern, and that's it. There's no price action to speak of to the left. That's an oasis pattern. They have a higher level of predictability. So anyway, we didn't get to questions. I'm sorry if we didn't get to them. Jolene is very good, by the way, of recording questions, and then we talk about, hey, what questions should we really have wanted to answer? And oftentimes what happens is we start out with questions not necessarily you asked today, but questions that were asked in the past that Jolene believes, based on other communications she gets from factor members, were commonly asked of factor members to her. And we may take the first 10 minutes or so of Q&A to kind of wrap up some of those questions. So anyway, well, I'm out of breath. I've talked a lot. Crazy markets, and I don't expect to be active here between now and Christmas. I've talked about December effect before. December markets are unreliable because, generally speaking, the power behind the buy forces and sell forces aren't willing to really stand behind their position and sponsor a trend at this time of the year, knowing that, we're going to enter a period of 2 weeks where they're going to be inactive. So there's just a lot of reasons why December markets tend to be trickier than normal markets, and they're markets that historically I've not been active in. So you take December markets plus the fact that we have markets that I don't consider to be conducive to the way I trade. I'm sorry. I mean, I know that some Factor members would like to have me be a lot much more active than I am, but I'm as active as I will be. So anyway, thank you all. We value the relationship we have with you. We value the fact that a number of you are willing to hang with us. So, Jolene, I'll let you wrap it up, and we will communicate with you all with an update at the end of the week.
Thank you, Peter. Have a good day. Since we're live right now, we hope you have a wonderful Christmas if you celebrate Christmas. And we just appreciate you so much. So don't think that just a service, that's plugging away and ignoring people. We really appreciate you. I read every email that comes through. So we thank you. Thank you for being members and thank you for being with us on this journey. And have a wonderful day and the rest of your week and a great December. Thank you.